All right, let's dive right into one of the absolute most fascinating financial mysteries currently unfolding in the markets. We're looking at SoFi Technologies, ticker symbol SOFI. Now, on paper, this is a company that is just crushing it. Record revenue, record member growth, record profits, you name it, and yet the stock has been acting like the company is in some sort of absolute crisis. So throughout the course of this explainer, we're going to break down exactly why the market is sending us such incredibly mixed signals on SoFi. We'll look at what the bulls are screaming from the rooftops, what the bears are warning us about, and the crucial metrics you absolutely need to understand.
So here's the core paradox we really need to unravel today. How exactly can a company achieve all-time operational highs across the board, yet see its stock just plummet? Normally, when a business reports its best quarter in history, Wall Street throws a massive party. But with SoFi right now, investors seem to be sprinting for the exits. To understand why there's this huge disconnect between the fundamental business operations and the stock price, we first need to look at just how good these recent numbers actually are. And those numbers start with a massive top-line beat. In the second quarter of 2026, SoFi reported a truly staggering $1.2 billion in adjusted net revenue. To put that into perspective, that represents a 40% year-over-year increase. Let's be real, in the current economic environment, growing your top line by 40% to over $1 billion in a single quarter, that's a massive home run. It just shows that money is flowing into their ecosystem at an incredible rate.
But it's not just about the revenue, it's about actual profitability. SoFi reported an adjusted earnings per share of 12 cents, which actually beat Wall Street's estimates. But more importantly, this marked their 11th consecutive profitable quarter. Just think about that for a second. A few years ago, critics were wondering if this fintech would ever figure out how to make a single dime, and now they're stringing together almost 3 straight years of consistent, solid profitability.
And the rocket fuel behind that revenue and profit? Explosive user growth. In just one single quarter, SoFi added 1.1 million new members. That is a record-breaking pace of acquisition, and it pushes their total member base to an incredible 15.8 million people. To put that scale into perspective, they also added twice as many products as new members, meaning their total product count grew 42% to over 24 million. People aren't just signing up, right? They're adopting multiple services.
Which brings us to a really stark reality. Despite adding 1 million users, generating over $1 billion in revenue, and achieving an 11th quarter of profit, the stock is down over 30% year to date. I mean, it's incredibly counterintuitive. A 30% haircut on a company posting record growth numbers tells us something absolutely crucial. Wall Street isn't looking at the current score. They are deeply, deeply concerned about how the game is going to be played in the future.
Section 1, the bear case, revenue quality concerns.
Okay, so to understand the bear argument, you really have to understand exactly what Wall Street loves. Investors absolutely adore what's called the loan platform business, or LPB. This is a capital-light model. You can kind of think of it like a highly profitable game of hot potato. SoFi originates a loan, and instead of keeping it, they immediately pass it or sell it to a third-party buyer. SoFi collects a really nice fee for doing the initial work, but they take on literally zero credit risk. If the borrower defaults down the line, hey, it's not SoFi's problem. This fee-based, predictable, low-risk revenue is super highly prized by the market. But here's the catch, and the absolute crux of the bear concern. Right now, that beautiful capital-light LPB model, it isn't the star of the show. Instead, balance sheet-intensive lending is completely dominating SoFi's revenue mix. What this means is that SoFi is actually keeping these loans on their own books. Out of a record $14.8 billion in originations, a massive chunk is staying right in-house. And when you keep the loan, you tie up your own capital, and worse, you expose yourself to cyclical credit risk. If the economy tanks, suddenly all those defaults absolutely do become SoFi's problem.
Outing to this structural concern is a pretty significant headwind over in their technology segment. The technology platform, which includes their acquisitions of Galileo and Technisys, actually saw revenue drop by 27% in Q1. Basically, losing a major customer took a massive bite out of their tech segment, pulling those numbers down sharply. So when you combine this sudden drop in tech revenue with management signaling that they need to bump up investments for future growth, well, bears see a prime recipe for near-term margin pressure and reduced profit expansion.
So the crucial point here is this underlying tension. The bear view focuses heavily on the present dangers, right? A riskier revenue makes heavily reliant on their own balance sheet, plus those immediate margin pressures. But to truly understand this company, we've got to flip the coin. The bull view looks at the exact same data and sees long-term platform growth and an incredibly sticky financial ecosystem being built right before our very eyes.
Section 2, the bull case, the financial supermarket.
Now, the behavioral data of SoFi's user base is absolutely fascinating. Just look at this breakdown. 51% of new product openings are coming from existing members. Honestly, this is the holy grail for a fintech company. It proves that SoFi's whole financial services supermarket strategy is actually working. They aren't just getting a customer to open a checking account and vanish. They're getting their direct deposit, then their savings, then their investments, and then their home loan. Once a customer has 4 products with you, they are incredibly sticky. The lifetime value of that customer just skyrockets.
And the bulls? They see massive catalysts across the board here. SoFi is expanding their highly profitable loan products by launching home equity and small business loans. They're also forming strategic capital partnerships with Sixth Street and BasePoint, specifically designed to expand that capital-light loan platform business we talked about earlier. Beyond that, they're publicly embracing crypto via the Clarity Act, effectively positioning themselves alongside giants like BlackRock. And perhaps most tellingly of all, CEO Anthony Noto has been aggressively buying shares with his own money. I mean, that is the ultimate signal of insider confidence. Section 3. The verdict and the risks. Analyst consensus and valuation.
So, no surprise, Wall Street is deeply divided right now. You have KBW slapping a strict sell rating on the stock with a $16 price target, specifically citing those exact margin pressures and balance sheet risks we just discussed. On the flip side, you've got Needham and Mizuho as strong buys in the $22 to $24 range, fully believing in the lending growth and the reacceleration of those partnerships. Overall, the consensus rating across the board sits at a hold with an average target of $19.27. It's a true battleground stock.
A massive reason for all that hesitation? Valuation. SoFi is currently trading at roughly 28 to 29 times forward earnings. Basically, that means investors are paying $28 today for every $1 the company is expected to make next year. In the banking and lending world, that is incredibly steep. It means the stock is essentially priced for absolute perfection. When you trade at a multiple that high, any slight miss on quarterly guidance or any tiny slowdown in member growth can trigger an immediate and aggressive sell-off.
Which means we must be crystal clear on the risks involved. Number 1 is credit quality. SoFi's personal loan net charge-off rate, which is essentially the percentage of debt they've completely given up on collecting, sits at 3.7%. While that's manageable now, if the broader economy softens, those defaults hit SoFi's bottom line directly because of all those loans on their balance sheet. Add in the high valuation multiple, the risk that their fee-based revenue takes too long to scale, fierce competition from traditional banks and big tech, and macro factors like sticky inflation, and you've got a minefield that management has to navigate perfectly. So what's the bottom line takeaway from this entire explainer? Well, the single most important catalyst for SoFi's future stock performance hinges on management's ability to reaccelerate that loan platform business. They absolutely have to prove to the market that they can grow their capital-light fee-based revenue streams faster than their balance sheet-heavy lending. If they do that, the market may very well re-rate the stock higher. If they don't, the pressure is for sure going to continue. Which leaves us with this final, really provocative thought to ponder. Is SoFi successfully building a sticky, generational financial platform that's going to dominate the next decade of banking? Or are they simply carrying way too much cyclical balance sheet risk to justify their premium valuation? It's a fascinating standoff between incredible operational momentum and deep structural market fears. Now, please remember, this explainer is designed purely for educational purposes and is absolutely never financial advice. Always make sure you do your own research. But definitely keep a very close eye on that revenue mix in their next earnings report, because it's going to tell us exactly who is winning the tug of war.